Anant Narayan, who's the co-head of Wholesale Banking South Asia at Standard Chartered Bank, joins in on the show right now. Anant, there seems to be a divide in opinion as far as ratings agencies are concerned. You know, you have Fitch saying that India has a stable outlook, but then Moody's comes and says that there is risk to India's credit profile. What's the way forward that you see?
I think the basic broad macroeconomics, at least till a month back, weren't looking too bad. You know, you had inflation being under control, you had the fisc looking like it was getting under control. Yes, the current account deficit was an issue, but the expectation was that from June and July onwards that would improve as well. And of course, you know, you had prospects of lower commodity prices helping us along. But, you know, if there's anything which has changed in the last month, it's clearly been this huge bout of volatility. Now, that does a couple of things. One is it endangers the regular inflow of capital that we need on an ongoing basis just to stave off the current account deficit. And second, of course, it sort of nudges up microeconomic concerns of corporates who have exposures in these markets and haven't hedged. So on both those counts, I guess the concerns have come to fore in the last month or so, and they remain. So frankly, it is at a kind of crossroads right now. Reality is the basic fundamentals have been improving over time. They clearly are better than they were 6 months ago. But the reality is that the confidence required for us to come out of this issue has ebbed in the last month or so. So this is a critical time in that sense.
Right. Anant, you know, in the last 24 hours, not only the equity markets, but even macro, a lot of indicators have taken a big shock because of all we know, commentary coming in from Ben Bernanke. But today, we are looking at some amount of recovery coming in from the lows on the rupee, almost, you know, touching 60. We are looking at 58.20 now. Do you expect this kind of a pullback to continue in the near term?
I think this pullback has been global as well. So, you know, the first reaction to Bernanke was pretty harsh because I guess by that time the market had sort of built in expectations of dovish talk from Ben, but he didn't oblige. But I think once you had some time for the markets to digest the information, this isn't really bad news. It's a kind of good bad news. If Ben Bernanke is withdrawing accommodation, it's because the U.S. economy is doing well, fundamentally. So at a macro level, that really isn't bad news. Plus, of course, in the last 24 hours, I think across the globe, we've seen a bounce of intervention by regulators, which obviously helped the cause as well. So look, we did see a spike up after the FOMC minutes. We did see the rupee moving up sharply and sort of creating a gap. There's every possibility that we fill that gap, come down to sub-59 levels, and that would be much welcome. There has been looks like there has been some intervention from the regulators, plus there seem to be some genuine flows coming in as well at these levels. So we could see some consolidation here.
Right.
But, you know, we're still not out of the woods. So even if we come down to 58, we still require some amount of stability and some amount of soothing of nerves to happen for the inflows that we need to start commencing again.
Anand, in the last 24 hours, we also witnessed a lot of pulling back of flows from the debt markets, including Indian markets, and we did see a circuit filter getting hit yesterday. What is your general, opinion on the Indian bond yields? Because last couple of months, we've also seen a lot of retail and HNI move their investments into dynamic bond funds kind of instruments. So, just wanted to understand, how do you think the yields move in the light of big redemption from the FI side happening in India?
Sure. Actually, the redemptions from the foreign institutional investors on the debt side have been happening for a while now, not just in the last 24 hours. So, for instance, in the last, I think, since May 20th or so, we've seen about $5 billion of outflow. The reality is, clearly this was on the back of global events and the specific volatility in rupee. You know, rupee lost 9% in 1 month. Now, that's a huge shock for a fixed income investor from overseas. And clearly, at some stage, you would see pullouts happening. Now, going forward on this particular piece, you need some confidence from the markets and from participants that, this kind of volatility is behind us. Otherwise, for a fixed income investor, looking at the prospect of 5 to 10% volatility on a monthly basis, it would require a lot of faith for a person to come in with fresh money. Specifically on bond yields going forward, three things sort of helped the bond yields and bond prices in the last, since this calendar year. One was the FI purchases. Second was the prospect of more monetary easing given growth and inflation coming off. And the third was OMOs by the RBI, where they came in and purchased bonds. Now, unfortunately, in the last couple of weeks, the prospects on all three have come down. FIs clearly are nervous, and you saw the SEBI auction yesterday of the limits, which had a very tepid reaction. Clearly, there's nervousness given the volatility of the last 1 month. Monetary policy, there are question marks going forward on whether we'll see rate cuts. There was a lot of expectation of rate cuts built in a month ago. That's clearly behind us given the volatility on the FX side. And OMOs don't seem to be forthcoming at the moment because liquidity seems to be under control, though that could change going forward. So at the moment, there is a bit of nervousness in the bond markets. Eventually, we should see some buying coming back. After all, banks aren't seeing credit offtake, so that demand should come through. Plus, once the advance tax money comes back into mutual funds, we should see some fixed income buying coming through as well. But at the moment, the range seems to have moved from, the new bond was expected to be between 7 and 7.25. That's clearly moved to a 7.25, 7.45 kind of range.
All right, Anand, we leave it at that. Thanks very much for joining us.